Hey, gang, I get asked all the time about the forecast for where's the mortgage market going? What are interest rates going to look like this year? Where is real estate going to be? And I get asked a lot of time by our residential realtor partners and friends. And a lot of our investors also ask and want to know. So here's our presentation for 2024. Hat tip to Barry Habib over at MBS Highway for most of this data, and he's just been a great source that we follow, one of the key sources over, gosh, 20 plus years. He's been spot on in so many instances. Here we go. I'm going to give you my best interpretation of what we see, and hopefully this helps. Okay, here's our 2024 mortgage market forecast. Our 2024 forecast centers a lot around supply and demand. And most prices are determined by supply and demand, but more than ever, real estate, as well as the direction of interest rates, will be focused on supply and demand. Let's begin with inflation because it's a big driver of interest rates. And as we look at inflation, where it stands at the beginning of the year is the core CPI number is at 4%, as you can see. And the core PCE number, these are both the numbers that the Fed looks at, but most importantly, the PCE is at 3.2%, personal consumption expenditure. The CPI is the consumer price index, and the Fed wants this personal consumption expenditure to get to 2%. And that's his target. But in December, the Fed meeting caused a major pivot. The Fed finally came out and said, hey, we're not going to wait to start cutting rates for the PCE to get to 2%. We're going to start cutting rates when before it gets to 2%. And when asked about it, Jerome Powell, he didn't give an exact rate where he would start, but he said he could start handicapping it. So let's take a look at the direction where we think inflation will go. So much of the inflation numbers are based on shelter costs. So if we pull this up here, shelters are renters and owners equivalent rent. So what do they look like today? If you took a look at the blended rent, they're gonna go up at 2.5% year over year, as you can see right here. That's blended. And you can see they went up and up here from 2020 all the way through 2022 during the COVID years. But they're still going up, although just at 2.5 percentage points per year. Now, new rents are going up at about -1% a year, so they're actually coming down a bit, but renewal rents are going up at about 4.5% a year. So when you blend the two together, the overall rate is about 2.5%, where the rents are rising, but that's a lot less than it was. The problem is that the Fed doesn't look at what we are doing currently. The Fed takes the last 12 months and averages those numbers together. And on top of that, people could have signed a lease in advance of that. And the Fed's data collection is really wonky, as we all know, a bit hard to trust. So you can have a very long lag. And it's evidence here because the way the Fed looks at it is this gold line here. And you can see that here was the peak right over here in February 2023. And you could see much later on started coming down and starting coming down here. You can see that these numbers lag, but eventually start to get to a similar location. And that's where we are today. We're seeing the Feds looking at these numbers, but we're really much lower. The weighting with inflation reports is rather significant. In fact, the CPI report shelter, it's 44% of core CPI. There's an enormous overstatement here. And the difference between these two is significant. When you take that mathematical difference, let's say the CPI 4% difference applied by the weighting over here, you'll see that there is a huge lag effect. And you see the lag effect here is between 1.8% on core CPI, giving you a 2.2% sort of real inflation rate today, and the core PCE, a 0.9% lag effect, giving you a real inflation rate today of 2.3%. So it's much closer to the Fed's target. And in fact, if you take a look at what the last 6 months this is, it's a run rate. The Fed, they actually do look at that, and it's actually below 2% at right around 1.85%. So these are important numbers, and the trend in inflation is working in our favor, and it means the Fed's going to have to look at cutting. And we can look forward to the upcoming reports or the PCE reports, knowing that shelter has such an enormous bearing and weighting in the whole overall average. And the way it works is you get a new report here. Let's see, you get a new number. And the next report, we'll get to shelter, and the CPI will be released January 11th. And that's for the month of December 2023. And that's going to replace the month of December 2022, which over here was very high, 0.79%. And by the way, the PCE number, that'll be released on January 26th. So this high number will likely be replaced by a lower number. See, we've been trending here since the last bit of June. These numbers are pretty much lower across the board. And so it's been around 0.4%. So we get a number roughly 0.8% replaced with 0.4. You can get a pretty strong benefit here in terms of a reduction in those indexes. And that'll be again happening in the months of January and February. We'll see in February and March of 2024. So the first quarter of 24, the reasons we should get should be quite favorable on inflation. We shouldn't see, I mean, we should see inflation come down. And after that first quarter, it gets a little harder to make progress because you can see we're getting more to a lower average as we had turned the corner springtime of last year a little bit. So it makes it a little harder to make up additional ground. But what does that mean as far as what the Fed looks at? So let's take a look here. All right, so you can see these numbers here. Let's move on. So what they're looking for here is the number in December 23 was 3.16%. So how does the math work on that? On January 26th, we'll get the December reading for a core PCE, and we're going to estimate it's going to come in about 0.1%. And the big reason for that is because I showed you we should make a lot of headway in those shelter costs. The same thing for January and February. So we know that in this area, based upon what I just showed you, we should see a relatively low numbers in shelter. But take a look for the rest of the year, okay? What we've done is just plugged in 0.2% for the rest of the year here. And it's reasonable based upon where the shelter costs were as they normalized at a lower level for the balance of last year. So when we get the new number, here's how it works. It replaces the year on overall core CP from the previous year, which was 0.39%. In this example, you can see 0.1% is lower than 0.39%. And so if you subtract that, you get 0.29. And from the current reading, what do you get? You get 2.87 year over year. That's below 3. It's in the 2s. It's not really quite close enough to the Fed's target, but at least we're heading in the right direction, right? With the 2s. I think for their position to start cutting and thinking about that, it's a positive, but most likely we probably won't see anything but the January 31st meeting on that. Let's take a look at what they'll see by their March 20th meeting. If we continue this process on down with the same concept of replacing the old numbers with the new estimates and where the numbers go, you'll see on March 20th as a reading 2.47. That might do the trick because they're seeing a pretty significant trend in the right direction. It's a good probability, but certainly by May 1st, where you see we're coming after the March meeting down to almost 2.07 is the estimate. And so what does the market say on this? Here are the sort of the futures cuts. Is Vegas ever wrong, right? DraftKings and football game, there's odds makers for everything. We thought the January 31st, they might start cutting. There's a 7% chance, according to the odds makers, when PCE, we think will be at 2.87%, that they will start cutting at that first meeting on January 31st. So we don't really think that's a really high probability, and neither does the market. But when we start looking at March, we see those percentages go up to 68% of the market thinks that the Fed's going to start their first rate cut. And certainly by the time you get into May, there's a 94% chance of a rate cut, 25 basis points, and even a 56% chance of 50 basis point rate cut. And then when you slide into June, then of course, 100% expectation for the rest of the year that everyone in Vegas thinks that the Fed's going to be cutting rates 25 basis points. But again, in June, 91% think 50 basis points and 53%, half of the analysts and the odds makers think it's going to be a 75 basis point cut. Let's take a look at the dot plot. These are where you take the Fed, the voting members of the Fed, all anonymously vote on where they think the cutting is going to happen or the increases. It has been the case for the last several years. And you look at in 2024, in 2023, no one thought there were going to be any rate cuts, right? So in 2024, this is where just about everybody thinks there's going to be rate cuts. There's the propensity of the middle of the members are thinking there's going to be, over the course of 2024, between 50 and 100 basis points of cuts on the Fed funds rate, which means prime interest rate will come down because prime interest rate is based on the Fed funds rate. So if you have an SBA loan that's based on prime interest rate, then you're going to see those SBA loans come down in interest cost. If you have a home equity line of credit, those are based on prime interest rate. Credit cards are based on prime interest rate. So many loans are based on prime interest rate. So that's a super positive. So if we go on over into 2025, we see that there is more expectation for even additional cuts. And you'll see, again, the bulk, if we look at the bell curve, the center of the distribution is in 2025, Most of the voting members think that the Fed funds rate is going to be somewhere between 3.25% to 4%, where today it stands at 5.5%. So that's a pretty significant drop. And again, it's trending in the right direction. It's trending in our favor. And again, into 2026, again, we're the bulk are thinking somewhere between 2.5% to 3% for the Fed's fund rate, which would put the prime interest rate, it's generally about 3 percentage points above the Fed funds rate. So you're going to see it about 6%, which is fantastic news. And then so when you look at the longer run, again, the odds makers at the Fed themselves, the current voting members, are really thinking that we're going to be in the 2.5% range. That's important. That's important to know what they're thinking, what their expectation is. And these are anonymous. That's the people that are making the decision about the rate cuts, what they think about it. All right, the trend is our friend here. The other thing that we have to take a look at is in terms of what's going to affect bond yields and mortgage interest rates are not just the Fed funds rate and the impact of inflation on those bonds, but also the Fed's balance sheet, simply supply and demand. So the Fed can do something called quantitative tightening or quantitative easing, where they buy bonds and they buy mortgage-backed securities and they hold them on their balance sheet. And when they do that, they're basically taking these bonds off of the market. So they're reducing the supply of those bonds. And when you reduce the supply, then demand goes up and prices go up, limited supply, more demand, prices go up. And the way bonds and mortgage-backed securities or mortgage interest rates work is the yields go in the opposite direction of the price. So as bond prices go up, yields come down. So when they buy these securities and put on their balance sheet, basically the Fed is buying these out of the market. They're taking them off the table. They're driving interest rates down. And that they did this, they've done this during the Great Recession of 2008, after 2008. They did it again massively in COVID. And if you'll remember, interest rates went down to the 2s and 3s, and that was primarily driven by the Fed buying, is really the biggest buyer of the bond market in the world, and just gobbling up from basically 4 trillion on their balance sheet to $8.5 trillion. In 2022, they realized that it's time to start quantitative easing. Actually, I think I got that opposite. When they tightened, anyway, the terminology is irrelevant. What they started to do is selling those bonds back off of their balance sheet. So they would sell the bonds off their balance sheet because they can't hold them forever. They have to sell them. So they essentially started flooding the market with bonds, 10-year bonds, treasury notes, mortgage-backed securities. And by flooding the market, then there's an oversupply of bonds for the number of buyers. And so therefore the price comes down because you have a bevy of buyers wanting to buy, but there's so much to buy, there's much more supply. So prices come down, and when prices come down, yields or rates go up. And that's one of the reasons why mortgage interest rates and the 10-year yield has been so stubborn for the last couple of years, because they've been clearing their balance sheet. Moving on now, you can take a look here at the averages of where they were. When you look at the total securities held on their balance sheet versus the gross domestic product and as a percentage, and you can see the average range in 2014 to 2018 was about 22%, what they held in the balance sheet versus our GDP. Well, as our GDP continues to grow, of course, the debt that they're holding does as well. And now, but you could see that the percentage is like 33%. So that's a 50% higher number than what they were comfortable with pre-COVID. Well, here's where we stand right now as of January 2024. They have been selling those securities off the balance sheet. You can see from 8.4 trillion down to 7.1 trillion. So the percentage has come down, and where we expect the GDP to come in January, it's starting to normalize. And if you can continue to extrapolate this on down, they will continue to sell off their balance sheet, but one of the big things they're probably going to do is slow that down. They've signaled that they're going to do that at some point. In addition to that, you've got an election year, and the powers that be are going to want to see lower interest rates. They're going to want to see some slowing down of the market flooding of the Fed. And you can see that by slowing down the sale, because they were very aggressive here in the last year and a half. The percentages start to normalize here by, interestingly enough, election time. We get back to the number that they were comfortable with in the mid 2000s. You can see right there, we think that you're going to see a pretty substantial impact in the mortgage market itself as a result of that. All right, a couple of things here too. There's a possibility that we could move into a recession this year, 2024, next year. A lot of people would argue we've been in one. It depends on the market that you're in. Some sectors have done very well, some sectors haven't. But an interesting thing is if the naysayers out there are correct and we do move into recession, and we've had an inverted yield curve for quite some time, which has been a pretty reliable indicator, then the mortgage rates always decline. You can look at recessionary periods or in these grade bars. And then following that, you see mortgage rates fall, recession here, fall, recession, mortgage rates fall, et cetera, et cetera, et cetera. All right. What's the forecast for rates? We think the 30-year fixed rate mortgage this year is going to be somewhere throughout the course of the year is going to settle in somewhere between the mid 5%, the mid fives, somewhere in the high sixes. And that's great news because last year we peaked at 8% on conventional rates, and that was just enough to choke a mule. So mid fives to high sixes is a pretty normal range and pretty acceptable for most people. Obviously, if your first step into the mortgage market was in 2021 when rates were 3%, that seems really high. But I think most people have really adjusted their expectations because that was an anomaly. And we've definitely seen a regression back to more normalcy. Good news is though, under 6% should unlock move up buyers. We're seeing some government rates right now, FHA, VA, are already below 6%. So that's going to help people move on up. The 10-year treasury, we're thinking we're going to be between 3 and 4.4%, again, because you've got the Fed stop the slowing down of their flooding of the market of taking these treasuries off of their balance sheet, and the expectation of long-term inflation to be much lower, because inflation, when people think inflation is hot, they're going to hold off for a higher bond yield before they buy them. And so that drives those rates up. The other thing that's interesting is a lot of mortgage companies and servicers built additional margin into their rate spreads over the last several years because so many of them took it on the chin in COVID and had a lot of what they call early payoffs, and they lost a lot of money when people were refinancing out of loans that they just got in. And to protect themselves from that and to sort of rebuild their cash coffers, they, as a whole, the industry, we saw the spread between the 10-year yield and the mortgage rate grew from a typical average over the last 30 years of about 2 percentage points all the way up to about 3 percentage points. So that additional built-in margin, we expect to start evaporating away when lenders feel like we're in a more normal market and they're not at risk of a tremendous amount of early payoffs. So a lot of really good tailwinds for us in 2020. Inventory remains tight on homes out there, and household formations are exceeding quite a bit the amount of household completions in terms of properties that people can move into. So that's great from a supply and demand standpoint, and that should keep prices solid. That and the fact that interest rates are coming down should also create more demand for again, the move up buyer and even the first time home buyer in the market. Just want to attack this affordability question that the media beats up every day, saying affordability is no longer in the mortgage market. And there's some truth to that. It's definitely a lot more expensive today than it was in 2021 specifically. So if you look at $1,000 monthly payment for a $240,000 house in 2021 with a monthly income of $4,000, which would be a 25% debt to income ratio, today, that same house would cost $280,000 due to the appreciation at a rate probably in the mid sixes. So the payment's going to go to around $1,800, which is a pretty significant increase, right? An $800 increase or an 80% increase in the cost of that monthly payment for that house. But you don't have to increase your income by 80% to cover the delta in the mortgage payment. Really, on a $4,000 monthly income, you only need a 20% increase in your income to cover that increase. And the good news is that already since 2021, according to ADP, household incomes on average have risen 15%. So you've almost covered the spread there. But in addition, as rates continue to come on down and as incomes continue to grow, we'll see this affordability issue become a non-issue going into the future. We're expecting real estate appreciation this year based on all the sources that we talked to be in the 4.5 to 5% range. Even last year, I think we ended up in close to 6% on average nationally in 2023, when a lot of people felt like the world was going to fall apart and crash and burn and houses were going to drop 40%. Didn't happen for a lot of the reasons we've already talked about. We expect transaction volume to be up 15 to 20%. So the flow or the velocity of money is moving in the right direction, which helps everyone in the market, buyers, sellers, professionals, you name it. Okay, so that's pretty much where we see the market for 2024. We're very bullish about it. We think it's going to be a great year for home buyers, home sellers, for real estate professionals, for investors. Particularly if you've got opportunity for maybe new rents aren't going to be quite as high, but continuing and renewal rents are going up. And it's a great time to position yourself as the market, the real estate market is strong and healthy. And I think we've survived or weathered this potential, the post-COVID storm. So let's have a great year.